Alright guys, time for another week ahead video. This week's video will cover the trading week running from Tuesday the 6th of April to Friday the 9th. Remember that it was a shortened week due to the Easter weekend, and I hope everybody, by the way, spent some quality time over the weekend and ready to get back into the saddle. It will unfortunately be a very quiet week that we are jumping into, with very few major events to look forward to. But given the very interesting price action we closed last week with and started this week with, there is definitely a few things we are watching in the week ahead, with lots of focus this week on risk assets as well as the US dollar. Now, after a very choppy first quarter of the year, risk assets have started the second quarter with a bang, as major equity futures printed fresh all-time highs last week, with month-end and quarter-end flows, which was expected to see some outflows in equities, now firmly out of the way. The market is turning its attention to the highly anticipated second quarter of 2021. Now, recall during the second quarter of last year, 2020, of course, the world came to a standstill as economies were shutting down and locking down completely to try and curb the spread of the virus. Now, that saw some of the worst economic data points on record, and as a result, it also means that the base effects for this upcoming quarter will be some of the easiest on records, which is expected to see some of the best economic data in the history of economic data. Now, the better economic data points also come at a time of unprecedented economic stimulus, with the US approving yet another 1.9 trillion fiscal bill, and plans of the next 2.2 trillion in infrastructure spending has already been announced. Then also turning our attention to the virus, the fight against the virus is also gaining momentum right now, with close to 670 vaccinations already administered, updated until April the 4th. And this is according to ourworldindata.org. Now, also, despite the obvious concerns there still is about new cases, so far the fallout has been largely contained by either vaccination attempts in multiple countries or their relevant lockdown restrictions. There is still a long way to go until we can claim victory over the virus, of course, but the recent push from major economies is good news for the rest of the world as well, as the faster they vaccinate and reach herd immunity, the faster vaccine supplies should become eventually available, or more readily available across the globe as well. Now, speaking of that incoming data, the easy base effects we are expecting is yet to kick in, but even with that in mind, the incoming data that we've seen so far for the world's most important and influential economy, which is of course the US, it's already firing on all cylinders. This past week we saw some stellar numbers. Below is the ISM Mfg PMI, which jolted basically to the highest level going back all the way to 1984. We also saw Friday's NFP print much bigger than expected, coming in close to 1 million jobs gained. We actually saw interest rate derivatives see some sizable reaction. Taking a quick look here at the Eurodollar futures, which is now implying a first possible rate hike from the Federal Reserve by as early as December 2022. Now, this was March 2023, just a few sessions ago. So we are seeing quite a fast change in policy normalization expectations. And even though faster policy normalization isn't positive for risk assets per se, the Fed has made it very clear that they are happy to be behind the curve right now. So the better than expected data should put more emphasis on the reflation narrative and further boost those hopes of a broad-based synchronized global recovery, as opposed to, sparking fears that the Fed is going to hike rates a lot sooner than they are currently expecting. Obviously, the market's pricing that in a lot sooner. So with the economic data starting to show some actual progress, alongside progress on the vaccine front, as well as additional fiscal stimulus coming in, the path of least resistance for risk assets remains firmly tilted to the upside. So the other question on that front then is, what about the US dollar? Won't the faster policy normalization, higher yields, faster economic recovery, and vaccine rollout see massive inflows into the US dollar? Well, not necessarily. Have some of these drivers been dollar positive in the short term and helped the dollar to push higher recently? Yes, absolutely it did. But we do need to keep positioning in mind. Remember that the dollar short trade was the second largest oversubscribed position in global macro at the end of last year, which always made it very susceptible to a squeeze higher from the short bets, either taking profits or just trimming down some of those exposures. Now, as we explained last week, once the positioning unwinding has found some equilibrium, we do believe it'll be more of a fair fight between the dollar and high beta FX, especially other currencies like the pound, as the attention turns back to that reflation narrative, which is of course more dollar negative. And I do think that the dollar's reaction to that stellar ISM Manufacturing PMI as well as NFP on Friday could be a possible indication that that squeeze run we've seen in the US dollar recently might have run out of steam, as despite the excellent data, the dollar failed to sustain any meaningful upside and instead continued to push lower in line with some very overdue short-term mean reversion to the downside. Now, as we noted in our week ahead video on the 7th of March, even though financial conditions, vaccine developments, as well as relative growth and inflation dynamics bodes well for some dollar upside in the short term, it might be more short-term while oversubscribed dollar positions unwind. But after that has run its course and yields find some equilibrium, it might be more of a fair fight at that time, which means the medium-term bias for the dollar does remain tilted to the downside. Now, if we do see the dollar finally moving back in line with its medium-term bearish bias, that would also be enough to give emerging market FX and equities also a bit of a breather, as the stronger dollar as well as higher yields in the US have been placing some stress on EM, where debt sustainability has become a point of concern. However, the recent CFTC data still shows elevated dollar short, so a further push higher due to positioning is a risk that we do need to keep in mind, not only for EMFX, but also for FX high beta majors as well. So turning to the week ahead, it's going to be a very light one, like we said, in terms of economic data, but that might just be what risk assets need right now. There has been quite a few events over the past couple of weeks which kept risk assets on their toes. The biggest one was the fast-paced push, of course, we had in something like global bond yields. More specifically in focus was US 10-year. As we noted in our previous videos and reports, in the current environment where yields are low and rising, it's usually a positive input for risk assets. And despite higher yields as well as steepening curves, risk assets have continued to push higher in line with expectations. So with yields more stable right now, it should be one less of a concern for risk assets as well. And like we mentioned, the other more recent negative driver, which is now out of the way, was expectations that month-end as well as quarter-end rebalancing would lead to excessive equity outflows and fixed income corporate bond inflows, as funds would need to rebalance portfolios after the big divergence in performance between equities and bonds during quarter one. A third driver was the move higher, like we said, in the US dollar. As we explained, once positioning has found some equilibrium, that reflation expectation should see some pressure return for the US dollar. Incoming data points will be very important to watch for the greenback on the back of that. A first clue that reflation expectations might be back in focus for the dollar was that muted reaction for the dollar on the back of that stellar data points we had in the form of ISM manufacturing and that NFP. If that muted reaction continues with good data, it could be a good barometer that the overall focus has shifted back towards that medium-term bias for the greenback. The other one to watch is the VIX. Now, we've been sounding like a broken record recently when talking about the importance of that key support area between 20 and 21, explaining that a sustained break below this level would signal a possible regime change for equity implied volatility. Now, after meandering around that level from the middle of March, we finally had a solid break below that range, with the VIX trading as low as 17.3. Now, that's the lowest post-pandemic print, and also back to the VIX's long run median of 17. So keeping a very close eye on the VIX will be very important in the week ahead, as always. And apart from that, despite a quiet week, there are a few catalysts apart from this that we can keep an eye on in the upcoming week that can create some further upside momentum for risk assets. A new quarter obviously brings with it new earnings releases. Here is a quick breakdown from the great team at Earnings Whisper, showing us what type of names we can look forward to for some earnings releases. And even though it's not going to be any major names reporting, any massively better than expected releases should be enough to nudge risk assets even higher. The other event we could also see some additional upside for in risk assets is the latest economic projections from the IMF, or the International Monetary Fund, which kicks off their spring meeting this week. Now, comments from the MD, the managing director of the IMF last week, already revealed that we will see updated projections, which will include an upgrade to the banks or the fund's expectations for global GDP. That should be one more positive tick in terms of risk assets. And then a bit later in the week, we're also expecting the release of the Fed's minutes of the previous FOMC meeting, where markets will want to see whether there was some contention among members regarding their willingness to allow the economy to run hot, and to see whether there was any more information regarding the levels of their comfortableness with inflation overshoots, obviously in line with that new average inflation targeting policy. Now, like we mentioned, with a very quiet week ahead of us like this, it might be just what risk assets need to grind out even more gains, as the path of least resistance does remain firmly tilted to the upside, with focus, of course, on how the dollar reacts as well. Now, below is a quick rundown of the possible sentiment shifts to use for your scenario planning in the week ahead. When it comes to FX high beta, we do maintain an upside bias in the medium term for the Aussie dollar, Kiwi dollar, and CAD, but given the BOC's recent actions with discontinuing some of those purchasing programs and the complete reversal that we've had in Kiwi 10-year bond yields after that recent push lower, we would prefer the Kiwi and the CAD above something like the Aussie, as we also have the RBA risk in mind this week. And looking at equities, even though we still maintain a bullish bias on a wide group of global equities, we would prefer to focus on the Nasdaq in this upcoming week with some short-term equity long exposures in mind, as there is some catch-up potential compared to indexes, of course, like the S&P or the Dow or the DAX futures. So starting with some potential bearish outcomes for risk assets, the first one would be just dismal misses in those earnings. If that comes, even if it's not major names, if we do see just massive misses in earnings, it could start to create a little bit of uncertainty about some of the upcoming names we have. So that is one to watch. Apart from that, if the VIX decides to break back above 21, that'll also be a negative input for equities, especially trading at all-time record highs. They would be more vulnerable from a breakout to the upside in volatility. And then if we do see in the Fed minutes, we see some appetite from some members for faster policy normalization, that could also spark a little bit of jitters in risk assets. In terms of potential bullish catalyst for the week ahead, just the opposite. Solid beats in earnings expectations would be just one more tick to the upside. Apart from that, if VIX can manage to stay below that very important 20 level, even if we test that level to the upside but reject lower, that would be a very positive sign there for equities. And apart from that, in terms of that Fed minutes, if we see absolutely no appetite for faster policy normalization from members, that should just be one more tick in the box, so to speak, for further upside in risk assets, and definitely something that we are watching in the week ahead. Do keep in mind that the possible bullish and bearish catalysts we've mentioned here doesn't necessarily depend on each other, and it's not ranked in order of importance. Each one of these catalysts has the potential of bullish and bearish reactions in their own right. And if they are combined, of course, with other similar bearish or bullish catalysts, the reaction can be bigger in terms of the expected price moves. Do also remember that the potential outcomes and potential market reactions in this report is merely a guide for what we would expect in the event of these various outcomes. And please do keep in mind that the market can always surprise in the way that it reacts. So the expected impact is never intended as a trade call per se, but rather intended just as a guideline for you in terms of your own framework for your scenario planning in the week ahead.